Andy, as you will probably find out if you haven't seen him speak already, is a very experienced Toastmaster. And he's going to talk about capital gains tax. So because he's such an experienced Toastmaster, he's going to make that really interesting. And not only is he going to do that, but he's going to make it really interesting with the use of body language, because body language can be used in any speech, as the wonderful Andy is about to demonstrate. So with his speech entitled Capital Gains Tax, please welcome Andrew.
Mr. Toastmaster, fellow Toastmasters, welcome guests. Okay, now, you guys have heard me talk about tax before, and it's always dull, but I'm going to set you a little bit of a goal with this one.
Okay.
Because I've had to give this speech for real at work, and what I kind of want you all to imagine is that you are the new intake of paralegals at our law firm, and we need to teach you this one really important thing about capital gains tax. Because what we do not want is you messing this up and costing us thousands and thousands of pounds. Okay? So I want you all to concentrate and get what I'm doing, because I may be asking questions at the end. There might be a test. Before we get to the potential mistake, I need you to understand what the principle of capital gains tax is all about. Because most people who do the jobs that we just hired you to do haven't got any experience of capital gains tax. They don't know about it. They haven't come across it in real life, which makes this Toastmasters audience probably a similar thing, because many of you will be in that situation. Now, capital gains tax is a tax that you pay when you buy a thing and then you sell it at a profit. Okay, so it's different from income tax, which is what you pay on your regular incomings, your business income or your self-employed earnings, your salary, your pension, those things. Those all suffer income tax. Capital gains tax is what you get when you make a profit on something. So you buy something, let's say it's an investment flat for £100,000. A few years later, you sell it for £200,000. You've made a gain of £100,000, right? You're £100,000 better off. And that is a gain which the revenue can tax. Okay, that's the basic principles. Now, we're all going to be dealing with the estates of people that have died. Now, the thing to understand about dead people, I see them all the time, is that dead people don't get any residence relief from inheritance, from capital gains tax. And there's a reason for that, which is they do not reside in their homes, which in turn is because they're dead. Okay? Therefore, if you've got someone who dies and we're dealing with their estate and their estate contains a house, then there is potentially going to be capital gains tax payable if we sell that house at a profit. So not a problem at the start. There's no capital gains tax until the day they die. Capital gains aren't running. But if you take the date of death value of that person's estate, okay, let's say, again, £100,000 at the date of death, if we then sell the property for £200,000, or £150,000, or £125,000, or basically anything more than £106,000, because there's only £6,000 of allowances that we've got, we will pay capital gains tax. Now that's inevitable, and capital gains tax isn't a bad thing to be avoided at any cost, because we would rather sell the property at a profit than make a loss and not pay any tax on it. But this is the core point that I need to come to. If we, this firm, we sell the property as executors, then we have only got a £6,000 allowance to set against it, and we have to pay our tax at 28%. Okay? You may say, what's wrong with that? What's wrong with that is that there are some circumstances where there might be much less or no tax if what we did instead was pass the property to the heir of the estate and let them sell. Yeah? Let me give you the clearest example of that. It's where the heir of an estate is a charity. Charities don't suffer any capital gains tax. So if we've got a property and the person died, it was worth 100 and we're going to sell it for 150, or as I say, anything more than £6,000 above where we started, then we are going to suffer a big capital gains tax charge at 28% on the difference between those two numbers, when if we had simply passed the property to the charity and sold on their behalf, we would have paid no capital gains tax at all. There would have been none. So if you ever make that mistake, it is going to cost us thousands of pounds. So that's what I want you to get. Don't ever make that mistake. Another circumstance in which it could happen is, suppose the person that's died had 3 children and they're dividing their estate among those 3 children. Now, if we sell, we've got one allowance and it's £6,000 and we're paying tax at 28%. I've already said that. If we were to pass the property to the children, well, there are 3 of them and each of them has got an allowance. So we can make a gain of £18,000 without suffering any capital gains tax at all. Another thing is, we, the estate, us, this firm, if we sell, we suffer the capital gains tax at 28%. But if the children are basic rate taxpayers, their rate of capital gains tax is 18%. So do you see, you've got more allowances and a lower rate of tax. And again, if we get that wrong, we're going to pay out thousands. So, bottom line, I don't need you to understand all of this. I just need you to understand that it's a problem. And I need you to understand this simple rule, that if you are ever selling an asset in an estate for more than £6,000, more than it was worth when we started, you have to come to your supervisor and work out what you're going to do about it, because something needs doing about it. Okay, everybody clear? Good. Mr. Toastmaster.
Thank you.